Hey everyone, welcome to Financial Revelations. I am David Szafranski, your host. Corey's going to put all the stuff, all the contact information below me. So if you want to call here, we do encourage people to call, ask questions. If you want us to, we manage money for a living. So if you want us to do that, we do that for you too. We'll manage your money and we'll set you up so that you could see everything that happens in an account, all that stuff. You could see all that. So you can call here for that. But if you just have a question that you want us to address on the podcast, we'd love to hear that from you. And we got one today that it's the kind of question I'd love to answer because it's a little wonky. I wrote a book called The Sin of Retirement. I want you to get a copy. There's a couple places where you can do that. www, I don't think people still say that, but I just did, sinofretirement.com, sinofretirement.com. You can order the book there. You can also go to Amazon. We have an ebook that you can get on Amazon. We have an audio book that you can get on Amazon. And so I want you to have that book, and I want you to share it with people. I think you're going to love it because what it does is it talks about how we've taken the idea of retirement and turned it into something that it was never meant to be. And I want you to retire. I want you to retire well. And I want you to retire according to this plan somehow, give or take. So also, we got a missions trip coming in March of next year. I don't know how many slots we're going to have open for people, but if you are interested, give me a call because we might be doing 2 next year. Now, people say, well, hey, gosh, what is it like on a missions trip with Szafranski? It's hot because we go to the Amazon. We go into the jungle. We live on a boat. A lot of people then say, well, what are the bathrooms like? That's always a big question. We have flush toilets on the boat. The boat is modern. It's not a cruise ship. You're going to sleep in hammocks, but you don't have to go to the bathroom in the jungle. You can if you want to, but we don't recommend it. You get showers. We have showers, kitchen. We eat on the boat, live on the boat. It's really not, well, it's a mission trip. So I think it's nice, but I was in the Army. I lived in a tank with 9 guys. Compared to that, this is nice. So I've also been doing some Moody Radio. Moody Radio changed. It went to a consolidated morning program out of Chicago. So all the morning shows, the local morning shows are gone. And not my favorite thing ever done, but it is what was done. So we're gonna deal with it. We're gonna move on. So I've been doing some Moody Radio. So pay attention to that. I want to do just a little bit of Fed talk before we get into the subject today. October rate cut is in the bag. That's going to happen. And really what the Fed is telling us now is it's okay to buy risk assets. What I saw when the Fed cut rates last month was rates kind of popped a little bit. Settled down, went back. I want to be invested right now. I want to have as little cash as is prudent in my investment accounts. So I always keep some cash in investment accounts, always some, but I'm getting invested. We're deploying cash. It's paying off. And mortgage rates are going low. I know my friend Lauren from Moody Radio has like a 25% mortgage. They bought a house at the height of the interest rates, and she's going to get a chance to refi probably around March of next year, March or May. Sometime around there, I think rates will be around 5%, sub 5% maybe. In other news, we have a government shutdown right now, and it does have a little bit of drag on the markets. There's things that aren't happening, but markets have been behaving fairly well. They've been very well behaved, and I don't think it's going to have an impact at magnitude. I just don't. Our government is too big. I don't think a lot of people would argue this. We want them to be efficient. We want them to be cost effective. We want them to do the things that they do well, which is not a lot. Any government, not just our government, not just this government. You go back all the way until the beginning of our country, and government is just not a very efficient animal. Now, there are some things that they do really good that private industry can't do, like national defense. You wouldn't want to farm that out and privatize it. I think, there's things there that our government is really good at. Nuance, not one of those things that they're good at. I think back when Elon Musk bought Twitter, He went into Twitter and he immediately fired 80% of the people that worked there. Nobody would argue that Twitter doesn't work just as fine as it did before he bought it with 80% more people. I think in some sense, that philosophy could be applied to just about any organization, but especially the government, which tends to build layers upon layers upon layers. So there is talk about the administration cutting people back, that they could do it now in a shutdown when they couldn't do it before. I don't know how much of that is bluster and how much of it is real, but I guess we're about to find out. And so I don't want to see people lose their jobs. What I want to see them do is get pushed into the private sector where they can make more money and be more productive. That's what I want. I want to see productivity. Okay, so what I want to talk about today is strategy going into the end of the year. We're in the last quarter. I'm going to put out an investor newsletter tomorrow that will go to everybody that's in our email list. If you're not in our email list, it probably means that you're not one of our investors. You can get in that email list if you send Corey an email and ask to be put in there. It's a constant contact thing. And so that letter's going to go out tomorrow. But my strategy going into the end of the year is, usually you say, well, I'm going to take some losses. I'm going to clock losses so I can realize those and offset some gains. The problem is I just don't have a lot of losses this year. We do not have a lot of losses. The one thing that I thought was going to be a loss was AMD, because it just hadn't really. Earlier in the year, we had looked at some of the chip manufacturers that hadn't really participated. They were nowhere near the rates of return of an NVIDIA and some of the other guys, TSMC. And so we looked at those, really took a hard look at them, started buying them, and they all took off. You could call them late bloomers. I don't know why they weren't participating, but they're definitely participating now. So that took AMD out of my long-term loss category. We're making money in it now. There's a few others that we bought. They're not household names, but they're pretty well-known names. So it does surprise me that they took so long to catch on, but they did. So what I'm doing now is, now I don't have a lot of losses to take. I think, well, I got to get all of my money to work. And that's where we're going. The way we manage money, and I know this is going to sound weird to a lot of people, or at least strange to a lot of people, but I see a lot of portfolios. I see things that other people are doing, other firms are doing. People bring them here. I give opinions and advise on other stuff. I see people managing not to lose. That's the way most people manage money. And so what happens when you... Our coach, my buddy Dan Henson, who coached for years and trained athletes, will tell athletes, whatever got you here, that's what you got to do. As you're going into the draft and as you're looking at, a new contract and all those things, don't play it safe. You got to play through the whistle. You got to run through the whistle. You got to play hard through the whistle, because when you don't, that's when you get hurt. And when you manage money to not lose money, that's pretty much what happens. For one thing, you're not going to make as much because you're so afraid that you're going to lose and people are going to leave. And I don't want people to leave. We don't get a lot of people that leave. We just don't. And I think part of it is because we manage to grow. We're growth-oriented managers. Even 75-year-old in retirement, we're going to have some growth component in there. Now, there's other things that if somebody comes to me and says, look, I need to produce income off of this portfolio at a high level, we're probably going to have a little less growth in there. Just, you can't do it. So I want to buy into these rate cuts. I want to be growth-oriented into rate cuts, but I want to be growth-oriented in just about anything. And there's always something that's growing, even in 2008. Now, a lot of you remember 2008. Why do you remember 2008? Because the country almost went bankrupt. That's why we remember 2008. It was the worst market of our lifetimes, unless you lived through the Great Depression. And no matter what anybody says, I did not. Unless you lived through the Great Depression, you've never seen a worse economy and a worse market than 2008. I remember I was in Columbus. My wife was making me go shopping for a chair, and it was a Friday afternoon. It was a lovely day, warmer than average. September 15th, I think it was, 2008. And on the radio, they said, on Monday, Lehman Brothers is going bankrupt. And I thought that is the most irresponsible thing to say. But lo and behold, on Monday, Lehman Brothers went bankrupt. Even in that market, there were things that were growing. You just had to find them. And so that's what we did. We had losses, of course, just like everybody. I'm not going to tell you I always catch the biggest fish. But we mitigated those losses by doing other things. And that's what we try and do. So in these markets, these growing markets, these aren't dartboard markets where you could throw a dart behind you with your eyes closed in a dark room and whatever stock you hit in the stock pages. They don't do that anymore. But in 2008, they used to print this, like the S&P 500 would be printed. What did it do yesterday? They don't do that anymore. But if you threw a dart at that prior to, like in the late 90s, you make money. Well, I don't think we're in that kind of market, but you could get focused enough to where it could happen. So I want you to be invested. We're being invested. I want you to be growth oriented if possible. And I want you not to don't manage your money not to lose it. Manage your money to grow it. I'm telling you, there's a difference in philosophy and there's a difference in the way we think that will make a meaningful difference in your balances over time. Now, there's going to be years where you're going to be like, hey, Dave, I don't think you know what you're talking about. And I've had those years. Everybody does. We always recover from them. So that's what we're doing into the end of the year. Newsletter going out tomorrow. I try and keep them brief because I know people, we're putting eyes on everything. Somebody asked me, well, what books are you reading right now? Well, I have one on my desk, The Theory of Moral Sentiments, that I'm reading. And I have the Screw Tape Letters. You say, well, that doesn't have anything to do with finance. Okay, believe what you want. So the question for today is, why is it so hard to get inflation back to the 2% target? And I love this question because I love talking about these things. When we saw the height of inflation, which was at about 9% during the Biden administration, a couple of things happened while we were experiencing those inflationary times. And that was UPS, GM, Boeing, and others all came up for contracts. All these humongous companies, and they're coming up for contract in the highest inflationary times, which was just, kind of fate. They didn't make it happen that way, it just happened that way. And so one of the things that UPS did is they rewarded their drivers with like a 20% increase. GM did the same thing, Boeing did the same thing. And that kind of embeds inflation into the marketplace because when the Fed started raising rates, it was easy. I mean, it was easy to go from 9% inflation to 5% inflation. You think, wow, that's a big cut in inflation. Well, yeah, it took a few months. You got to have the impact of the rate hikes and all those things. But that first bite at the apple is a pretty big bite. You could take a lot out with some quick rate hikes, and the Fed will talk a lot and they'll talk about rate hikes, and you start to see money supply tighten up and inflation comes down. And then you get into that 3.5%, 4% range. And now you got the wage inflation that's baked in from those big contracts. You got other costs that went up permanently in those big contracts. And those wages aren't going to come down as inflation comes down. So that last percent, that going from 3.1, 3.2 to 2%, is really sticky. It's really hard to get back there. And that's why it was so disappointing to me when the Fed waited so long to address an obviously inflationary economy. We talking about UPS and GM and Boeing and the others, we want wage growth. I want you to make more money every year. I want to make more money every year. We can do those things without causing rampant inflation. The way you do it is you become more efficient. You increase productivity. You make more with the same amount of people. So instead of producing 5 widgets an hour, the same amount of people are producing 10 widgets an hour. So you haven't added to your cost, but you brought up productivity. So now you can get a wage increase and not have it be inflationary. In the first Trump administration, we saw extraordinary gains in incomes across all socioeconomic scales. Extraordinary. And it did not create inflation. In fact, the Fed was trying to create inflation and they couldn't because productivity was booming so much. We have a chance to do that again. We do have a chance to do that again with artificial intelligence, making things more efficient. And in some cases, what artificial intelligence is going to do is going to take the lowest level jobs. Is a good example of this because they have taken the first level of customer contact and made it AI. So all the people that were doing that in the call centers all around the world, and they have them everywhere, they're now handling higher level problems. So if somebody calls up and says, hey, I forgot to pay my bill, AI, it's a computer. It may sound like a person, but it's not a person. So that's a productivity increase. Now you're taking people away from easily managed problems, the easiest managed problems, and you're putting them on higher level, higher thinking things. That's a productivity increase. That's like a simple version of it. That's going to happen in more places. So as we get more productivity increases, you will see inflation drop, but it's very important that the administration focus on increasing productivity. That's how they're going to get inflation from 3% where it's at down to 2% where they want it to go while having rate cuts. You know, inflation is still above target and we have rate cuts. And we have that because the job market's kind of weak right now. And the Fed is kind of caught between a rock and a hard place with weak job growth, but higher than needed or wanted inflation. So the things that would help job growth, actually, that help inflation go lower, create a weaker job market. It's called stagflation. We don't want to be here. So the administration must focus, must focus on productivity gains. That's what's going to get inflation down to 2% or somewhere sub 2%, which is where I want to be. But the way the world thinks about inflation is kind of the grease that keeps the economy rolling. And it's way better than deflation. A little inflation is way better than a little deflation. Deflation, the housing market stops. When the housing market stops, jobs stop. You got to keep house prices going up a little bit every year. Some of it is inflated and some of it is real, okay? But the house you're going to buy once you sell your house also has a little bit of inflated and a little bit of real. So it's kind of a fair deal. I am David Szafranski, a real American, a true red-blooded patriot, and the voice you can trust.